With today's session in the books, there are now just 21 days in the trading year left for the year. Let's take a look at the winners and the laggards in the S&P 500 so far this year. First, the top five. Pulte topping the list. That also includes Sprint, Whirlpool, Expedia, and Lennar. Worth noting, every name on this list is down in today's trading session. However, look at those triple-digit moves for the year 2012. These are the winners in the S&P. Let's take a look at the laggards, and we've got Apollo Group leading that list, down 64% year-to-date. Advanced Micro, Cliffs Natural Resources, Hewlett-Packard, of course, 50% of its value wiped out this year, and JCPenney. So are these names you should be putting on your buy and sell list? Joining me now to talk about strategy is Morgan Stanley Wealth Management Chief Investment Strategist, David Doris. David, always nice to have you on the program.
Nice to see you, and happy St. Andrew's Day.
Happy St. Andrew's Day.
November 30th, patron saint of Greece, Russia.
And it's Greek Day here at the New York Stock
and Scotland,
Exchange.
yes.
And so we want to go through the winners and losers. What are you doing at year-end? Is there a strategy that you do at year-end, getting ready for the new year in terms of your investment portfolio?
I think you want to basically sell off some of your losers, clean up the portfolio, Maria. We want to be a little bit defensively positioned going into the coming year. We think the market this coming year will only close in 2013 at 1434. It closed at 1416 tonight. 1434 at the end is only a 2% gain. You add in the dividend, you've only got a 4% gain. So buy some of your dividend-paying stocks, your Johnson & Johnson, your Abbott, okay, your Pfizer in the healthcare area. Secondly, go for some of these stocks that have come down a little bit. Apple, 706 was its high back in September, as you know. That stock is still up 50% plus for the year. We think that thing can go to 720. Right. So buy that. Buy some Oracle. Buy some Microsoft.
Well, I know this is all selective stock picking, but what about this whole theme about the fiscal cliff, about the idea that even if we don't go over the fiscal cliff, there's still a worry about what happens to the economy in 2013. So broad economic landscape. What do you think
economic
happens?
Landscape, Maria. You want to be in some high-grade corporate bonds. I'll tell you a group that's lagged way behind this year because of concern over taxes is your master limited partnerships. These things yield 6%, 5.5%, 6, 6.5%. They're down 2% for the year. These are infrastructure stocks, as you know. That's a flow-through like real estate investment trust. You want to have some of those. Emerging markets. Listen to this, Maria. China is down again this year. It's been down 4 years in a row. China's down 10% plus this year. Listen, China is selling right now at 8 times next year's earnings, if those earnings come true. Russia's selling at 6 times next year's earnings. China and Russia would be another in this broad picture that you're talking about. You want to own some emerging markets. So get some emerging markets, some master limited partnerships, some high grade bonds, not high yield bonds.
Are you worried about taxes going higher on dividends, on cap gains in 2013? Does that cut into the reason to buy stocks?
Maria, I think many people poo-poo and say it has no effect. I think it does have some impact. We go from 15% to 43%, which could be is a very, I think at the margin that can influence people. And this is why you want to basically find these companies that have a defensive characteristic and where you are getting enough yield so that even after you lose the dividend, you've got some income. People are chasing yield all over the place. Corporations are buying cash. Banks are buying liquidity. Central banks are buying government bonds. Foundations and endowments and pension funds are buying alternatives. Individuals are buying bonds, and really rich individuals are buying jewelry, art, and trophy real estate. Nobody's buying stocks in a big way right now.
Yeah, and yet Morgan Stanley for 2013 has come out with a more optimistic call for the S&P 500 for next year. That's different from this year. You know, your strategist, Adam Parker, has been very good.
1167.
He had an 1167 forecast. So what's the optimism for 2013?
Well, we think that 2014, Maria, that you can get $110, and we put a 13 times multiple on that. $110 times 13 is about a 1340 closing price. So you're looking at the end of 2013, you're looking at 2014 earnings. He is still looking for 2013 to be down. So we could have the market go down a little bit, and you can actually, if you wait a little bit and buy in after the market's sold off, you might have a better than a 4 or 5% total return for next year.
You still like dividend payers. You're sticking to the dividend payers.
Like dividend payers.
A Pfizer, like a J&J. You like technology.
Yes.
Does that argument change if dividend taxes go to 44%?
Well, that's why you want to sit towards the front of the classroom. If they're going to cull the classroom, stay away from these low dividend yield stocks. One of the
low dividends, not high dividends.
Low dividends. Stay away from them because if you're cutting the low in half, Maria, you've got almost nothing left. So if you cut a 6 or a 5 by 40%, you've still got some yield that's better than government bonds right now. 10-year treasuries are yielding 1.6%.
Crazy. No wonder everybody's searching for yield. David, always nice to see you.
Thank you, Maria.
Thank you so much. David Dorff.
Nice to see you.